Thank you for joining us for our 10 steps to improve investment return. This is step 1, adopting a long-term investment approach. And we've kind of discussed this in the past about adopting a long-term investment philosophy, and it goes hand in hand with that. So why does a long-term investment approach work better than a short-term? This goes hand in hand with the argument of being an owner versus being a speculator. And we're talking about common stocks here. When you buy a common stock, you're buying an ownership portion of a business. If you treat that as just a piece of paper to buy and sell, you're trying to play the greater fool game. You want to pay something for something and have someone buy it the next day for more than what you paid for it. But to actually realize long-term growth, you need to look at your ownership as being the owner of the business. An entrepreneur understands this very well. They come up with an idea for a business. They have to pay the government to open up shop. They have to find a place to house their business, update it, purchase all the materials it takes to make a product, and purchase their clients through advertising. They understand that the profit and the investment return does not come the next day. It's much further down the road. So when you want to experience this ownership growth, long-term growth, you have to allow yourself to be an owner long enough for that to happen. This is very common in the companies we own. We own the very big, large companies. It took a long time to get to the point they're at, and you should understand that they don't double business overnight. Management has to lay down long-term growth plans, and then they announce it to the world, and then along the way, quarter after quarter, they announce their returns, and if you're an owner long enough, you will realize that reinvested capital and be able to share in the profits of the company.
That's not just backed up by hearsay or what we say or what even Dr. Paul Woolley says. Historically, for well over 100 years, common stocks, you've heard this many times, have produced about a 9.5% consistent rate of return. That rate of return is actually split though, 5% of it due to capital growth, 4.5% to do with dividends. Neither one of those has to do with the day-to-day fluctuation of common stock prices. Over time, we've seen hundreds of years of real returns that have done just that. Capital at about 5% growth, dividends at 4.5% a year, the combination approximately 9.5%. You don't need to trade your way to success. In fact, that's one of another steps that we'll talk about in the future. Stay tuned.